presentation underway, so just give me one moment as I set that up. All right, so we are recording here, and let me just share my screen briefly, and then I'll go ahead and I will um, I will introduce our speaker today. So for those of you, everyone on the call knows me here today. So Chris Price, I'm the co-host or host of this wealth mindset and real estate investing meetup here. I'm also the CEO and co-founder of Red Fox Multifamily. And today we are going to have a special guest speaker come and talk to us about real estate versus stocks and why it's important to diversify. And our guest speaker today is Dimitrius Augustin. Dimitrius was born in Taipei, Taiwan, and he's fluent in both Mandarin Chinese and Demetrius brings a global mindset and educational and professional background immersed in finance and real estate. Demetrius' refined analytical skills enable him to quickly assess and value the traditional metrics of an investment asset, particularly real estate, and make recommendations and purchases accordingly. Demetrius's career spans Fortune 500 firms such as AXA, Merrill Lynch, Mass Mutual, as well as a boutique financial services firm, Global Wealth Strategies, where he helped clients navigate through complex financial challenges, offering sound solutions while mitigating risk. Demetrius's primary role at Take Two Financials is to analyze and assess value add buildings while also raising capital. Demetrius has been living in the Phoenix area for the past 28 years and is married with two young children who actually happen to be ill. And again, I really appreciate Demetrius taking the time out today out of his busy schedule to share these great insights with us today. And the last thing that I'll say just before we get into the specifics here is just from a logistics standpoint. Please, everyone, if you can, mute your lines when you're not speaking. If you can, hold your questions to the end. Although, as Demetrius mentioned, we do have a small group, and so maybe we might have an opportunity for folks to join in and ask questions as we go if they're burning. As I mentioned, this presentation will be recorded. And as always, you should know that this material does not constitute an offer or solicitation to purchase any securities here. This is for information purposes only and should not be construed as business, financial, or legal advice. And you should consult your business or tax or legal professional for any specific advice for your specific situation. So with that, I'll stop presenting and I'll hand it over to Demetrius so that he can present, and I'll admit the guests that are in here, and then we'll go ahead and get things going, Demetrius. So you can go ahead and share when you have an opportunity to.
Okay, perfect. Thank you, Chris.
Mr. Price,
Hello, Jim.
how are you?
Doing well. How are you doing?
Doing great.
Great.
Hmm. Okay,
Just getting started here.
right. So just hit open share. Is that what it
Yeah,
is?
the share, and you'll have to, and it'll say share screen, and then you'll be able to share.
I'll be right back, Chris.
Okay.
Because I'm hitting open share and it's just not. It's just showing me a black screen.
If if you want, I can share on your behalf, and you can just tell me to
Yeah,
navigate.
yeah, that's fine. Just so I'm not as familiar with Microsoft Teams as I am with Zoom.
All right.
Perfect. Awesome. Thank you. Thanks again, Chris, for the introduction. Hello, everyone. Want to first thank you guys for being on the call. I know for me, I live in the West Coast, so Phoenix, it's only 4:30, but I know for some of you, it's a little bit later. So thanks for taking the time out of your day. Hopefully, I'm able to provide some insight and some good information for you. So today's presentation obviously has to do with real estate, and the discussion is comparing real estate with the stock market, right? Why it's important to diversify. That's not necessarily to say you shouldn't invest in stocks, but why it's good to have more sectors or options to invest in besides the stock market. So go ahead and hit the next slide, Chris. And so Chris already covered this one, so you can just go to the next. So the agenda, I'll talk a little bit about myself, my background, and then from there we'll start getting into the presentation. So benefits of real estate investments, trade-offs of real estate versus the stock market, and then tax benefits in regards to the real estate market. So a little bit about me, like Chris had mentioned, I was born in Taiwan. I do speak Mandarin. My background is in finance. So I got into the finance business about 2013. And the companies that I worked for in the beginning were, Fortune 500, which was AXA, Merrill Lynch, as well as Mass Mutual. Before I ended up with a boutique firm about 5 years ago. And so I've been able to get a good, clear idea when it comes to a true not true diversification, but having that more of a holistic approach. Some of the companies that I worked with in the beginning, the focus was a little bit more on the risk management. So it's talking about life insurance, annuities, and your typical assets under management. And and so that's a little bit of background about me. I grew up in Phoenix, Arizona, went to ASU, for business administration, and obviously I didn't really know I was going to end up in finance, but it kind of just led me that way. But I was actually doing real estate on the residential side as a realtor while I was in college, and that was right after the market had crashed. So I got into real estate 2008. And really liked the idea of real estate, but I wanted to have something that had a little bit more stability in terms of when on the residential side, I felt like I was starting over as a realtor, year after year. And so that's how I was able to get pulled into the finance world, where you can really grow your business year after year. So when it comes to trade-offs of real estate, obviously there's a few things that I want to point out, as I'm sure some of you already know, but there are certain things that are viewed as things that kind of limit some people. So when it comes to trade-offs, one of the biggest things is the high minimum investments. So any type of real estate deal, they typically require a higher initial investment. So typically that's starting anywhere between 25 to 50,000 is like their initial investment. Certain situations and certain deals you could find that will actually be less, but that's a little bit of a different. Typically, you're going to see minimum investments about 25 to 50. Another trade-off is lack of industry regulation. So sometimes a lot of the guys say, when it comes to commercial real estate, it can be like the wild, wild west. There's obviously nowhere near as much regulations as there is with public markets, SEC, where you're constantly being they're constantly being watched over on a day-to-day basis. I would know when you're just working as an advisor, every trade or any deal that was done, it was picked through with a fine comb to make sure that is the right investment, and you always had to have an explanation as to why that person is going to move forward with this deal or this particular investment. Another trade-off is the non-liquid asset class. So what I mean by that is, yes, the real estate is much more illiquid, meaning that you're not going to be able to just sell and say, hey, I want my money back. You know, like let's say if you're like, oh, I need my money, and you're not going to be able to get that back. And if you can, in certain situations, sometimes you might end up getting less than what you initially put in, just due to the structure of the contract. So that's another trade-off. And the last one that I'll talk about is long hold periods. You're not typically when you're investing in these real estate deals, you're not going to be seeing that money. You'll see the cash flow of the preferred equity that the group had promised, but you won't be seeing the full amount until anywhere between 3 to 5 years. Sometimes it could be longer, just depends on what's going on in the market. Let me go ahead and hit the next slide, Chris. Thank you. So when it comes to real estate, there's definitely the multifaceted return. So this graph kind of gives you an idea of just all of the different ways of how real estate is utilized. So one of the things you talk about is depreciation. Obviously, with cash distribution, you can benefit that for favorable tax. There's the distributions, which you're getting that cash flow on whether that's a monthly basis or quarterly, but annually that's usually anywhere between 6 to 8%. There is the principal pay down aspect of it. When you are in these real estate deals, typically the rental income from the tenants is helping pay down the mortgage or the loan principal. So as you're doing that in an environment that's depending on what it is that you're doing, you are able to then appreciate, in certain situations you can force appreciate that property without really having much reliance on the market. So a good example of what I mean by that is when you look at residential. So residential their value has a lot to do with comps, right? So when you're in a single family home, if all the other areas in your home is selling for $200,000, and then typically your house is going to be worth around $200,000. Whereas in commercial real estate, usually in certain situations it's self-comping. So it's just more about what that property is able to produce for the investors instead of relying on comps around the area. So we'll get into the difference between, or the comparables of real estate and the stock market. So in this graph, in the dark red is the S&P 500. In the lighter red, it's commercial real estate investments. And so it's basically using the NCREIF, which is the National Council of Real Estate Investment Fiduciaries, which is it's a primary index used by institutional investors in the United States to analyze performance of commercial real estate. So they use it as a benchmark for actively managed real estate portfolios. So if you could see in the graph, from the starting point of $100,000, if you had invested that money in 2000, at the end of 2015, if you had just invested that in the S&P 500, you would be at about a little over $187,000. Whereas if you had invested that in the commercial real estate, that money would have then been close to a little over 373. So you've almost 4x the money compared to the S&P 500. So low correlation, better diversification. What I mean by that is real estate does not have a high correlation with the stock market. The stock market can be doing very poorly, but the real estate market can be doing very, very well. A great example would be what's going on right now. I mean, there's still, obviously with rising interest rates, there's a little bit of a slowdown, but I live in Phoenix. The Phoenix market here has just been insane, whether it's single family or commercial. everything has just been constantly seeing increases of value, whereas you've been seeing what's going on in the stock market. There's been days where it's going down, and then it comes up a little bit, but then it goes down again. So there's a lot of fear out there and speculation. So a lot more volatility when it comes to the stock market compared to the real estate market. And so this is kind of a illustration of something like that. So the just give me 1 second here. I can see what there we go. So risk-adjusted return. So it's the Sharpe ratio, which is the measure of the return on investment compared to risk. So obviously, the closer the ratio is to 1, the less risk it is. So in this illustration, the stock market has a Sharpe ratio of about 0.3, whereas commercial real estate has a Sharpe ratio of 0.5. So it's essentially less risk to invest in commercial real estate than it is to invest in the stock market. So typical return profile of real estate. So kind of just walk through that. You have, when you acquire a property, typically you'll have regular distributions. And like I mentioned before, those distributions usually is going to be anywhere between 6 to 8%. Sometimes you might find deals that's a little less than that. Sometimes you might find deals that's higher than that. Just depends on what kind of deal. But in general, you're usually going to see it in that 6 to 8% range. When it comes to the returns of real estate, you also have appreciation. There's 2 different types of appreciation. There is just your natural appreciation with what's going on in the market. Inflation is at all-time highs, and so that is, when inflation is high, it actually goes hand in hand with real estate. So that's why a lot of people say that in commercial or real estate in general, commercial real estate is a good inflation hedge. Because you're able to, it's cost of goods, everything's rising. So the same thing that's happening with commercial properties. If you look at apartment complexes, especially in areas where people are moving to, you'll see that every year, or when leases are expired, they're jacking up rent rates at astronomical numbers. It's baffling, honestly. And then in those instances, you also have return of capital, right? So what I mean by return of capital is in certain situations, if you're invested in a deal, the group could decide to refinance before their designated hold period. So let's say a 5-year hold period, and year 3, like, oh, we're going to do a little refi and return a percentage of capital to our investors. So that could be a portion. So it could be 75%, or it could be more. There's been instances over the past couple of years where investors will get 100% back of their capital, but still be involved in the deal and still get that passive income. And then the last thing would be the sale of the property. Obviously, when you get the sale of the property, that's when you also get that big chunk of equity that comes with the deal. So talking about tax advantages of real estate, there's quite a few. One of which is there's tax-free distribution. So you're able to offset depreciation and other real estate for specific tax treatments, which allows you to write off, when you're doing your taxes, write off a certain amount depending on what that might be. You can defer your capital gains. So that would be what's called a 1031 exchange. So if you didn't need the money, and let's say the property is sold, you can then take that money and you would have to invest it into a similar asset. So it would have to be real estate, and you would be able to just skip or defer your capital gains. You would have to pay anything when it comes to the capital gains aspect. And then again, paper losses reduce taxes of other income source. So in certain situations, you're actually able to offset income from your other investment sources, which want to make sure you have a pretty good CPA in those regards. And so that's pretty much all I have. I wanted to obviously open it up to you guys, more of a Q&A, see what kind of questions you guys might have, and address it from there.
Oh, Demetrius, thank you for the presentation, for the overview and covering that content. I think it was really tight and focused on on the benefits and the risk of both real estate and the stock market. All investments have risk, as we all know, and but I think it's recognized that from a real estate perspective, especially when you showed that sharp curve, or the sharp index, showing how from a risk perspective, in general, investing in real estate is less risky compared to the stock market. So, and I think there's definitely a misnomer out there for folks who for all of us really, who have grown up and have been educated in certain ways to think about these things. But I think this is a great time to turn it over to some of the guests here to throw some questions out at you to see to have you answer them and take it from there.
Yeah, and I will just add before the questions start coming. Obviously, my background is a financial advisor, so I still invest in stocks. By no means am I saying stocks is something that you want to stray away from. I mean, there's still several pros of investing in stocks, right? Like, you have liquidity. It's very easy. You can be on your phone, and if you want to buy a stock, you can purchase a stock. If you want to read about it, you can read about it just through your phone. The cost of entry is very low. You could have $250, and you'd be able to invest in stocks. And you're able to diversify across multiple sectors. You don't have to, in terms of if you want to invest in, medical, something or tech, you're able to do so without actually having to be in that business. So there's definitely pros, but it's always good to be able to diversify.
Awesome. Giovanni, Jeremy, how you guys doing? Good to see you.
Doing well. Doing well.
Excellent. Please feel free to throw out questions if you have them.
From my side, great presentation, good information. I'm on your side, so I don't really have questions. I advocate for real estate investment, multifamily investments. The person who's never done it, dip their feet at a single family, rental or something, 2-family, give it a shot, and or take the experience of somebody who's seasoned and let them help you to create good results. So I'm a big advocate for this approach.
Right. Yeah, and there's nothing wrong with that. As I'm sure you know, anyone that's majority of people you talk to that has made the switch over to multifamily or maybe other sectors in the commercial real estate realm, they usually typically started from residential, single family, and usually the reason why they made the switch is just because of scalability. You're able to scale much quicker, much faster in commercial real estate compared to single family. Not that there's anything wrong with single family. Single family is still very profitable, and you can still make it a great business without ever getting commercial real estate. But for some, they want to have, they might have their full-time jobs, and they want to be able to still grow at a much faster rate, and it's an alternative.
Agreed.
Hey, Dimitrius, thank you for the presentation, though. A lot of good information. Quick question, though. What would be the option for someone that wants to get their money out of Wall Street and put into real estate? For example, if someone has a retirement account, like a 401k, and they would like to move that money from there and put into real estate, what would be the options?
So yeah, you can definitely invest. You can have retirement accounts and invest in real estate. Now, there's different. It depends on the situation. So if they have you can't. If it's like a company, retirement plan. So if they're still working, there might be some restrictions. So you just got to make sure that they have the ability to take the money out of their whether it's a 401k or IRA, if they're still working. But if they're retired, yeah, you can absolutely take a portion of, depending, it could be a portion, it could be all of it. I would say it would, the factor would also be what are you invested in currently when it comes to stocks, because it's never best to sell and out of a position when it's down. That's but again, there's several factors that come into play about the investment time horizon. So if it's someone that's much older and they don't have a lot of time to be able to build back up, so it's more going to be the discussion is going to be capital preservation. So yeah, they might want to have more cash flow, so that would make more sense for them to take that money out of their retirement account and put it towards real estate.
I understand. Thank you.
Yeah.
Mm-hmm.
And Demetrius, can you maybe speak to like the self-directed IRAs and solo 401ks as tools for folks to use to invest in real estate?
Yeah. So there's obviously different benefits when it comes to the solo 401ks. There are different plans out there that allows you to really apply the investments in real estate, and that can be several aspects of it. So you are reducing tax liability. I don't want to. I'm not as familiar with the transferring of, because what I do know is that there are things that come into play when you're using retirement accounts. But I guess the answer would be, if you are looking to move money out of your retirement, you can do so. But what you probably want to do is first look at different retirement vehicles. So you don't necessarily have to just take it out of whatever retirement account you have. There are different retirement vehicles that allows more flexibility. There's I'm sure you guys know the UBIT tax. So there's and I know, Chris, you and I have talked about it, an account that allows you to avoid UBIT tax, which can be which can be very significant in certain aspects, depending on how what type of real estate you're invested in. So I think my advice would be figure out what would be the best retirement account for your situation, and then utilize that with your CPA to be able to discuss the tax advantages for those accounts.
Jeremy has a question. Go ahead, Jeremy. And you're on mute.
I'm gonna just quickly comment to add to Mr. Augustin's statements too. I mean, I'm assuming that if you're thinking of going into real estate and you have funds in a retirement product of some kind, that you're thinking about, most people that are on here are maybe exploring, if that's the case, or looking for investment opportunities. So there are some fixed type of things that you're going to go into, but I think it's important for you to get like some advice from experts based on your unique situation first, right? But also know that there are scenarios that you can create for yourself that are not tax oriented, meaning you wouldn't lose money as tax penalties, etc. That you can move some of the money out of, say, for example, this is not financial advice, this is just scenarios, but you can move from a 401k into your own product that you can then turn around and invest into some kind of real estate thing that can product or vehicle that can help benefit you in the same way, right? Especially when you have like stock issues and so forth and so on, you can do that. Surely also you can move cash out of insurance policies, right, that is not taxable, and use that as well. So if earlier one of the lowest points was 25,000, and if you had a life insurance policy that was accumulating cash, you could consider pulling some cash out as an option to start, and use that cash as an initial and start paying some of that cash back, so you can manage the interest rate trade-off. So consider those are some other options as well, but definitely find an expert that is neutral, that can give you some guidance based on your unique situation as well. That's what I would add.
Great comment. And to add to the comments that for both the with both Demetrius and Jeremy, I would say one of the other things, Giovanni, that I've seen folks do in terms of leveraging the funds that they have accumulated in their retirement accounts, whether it's a 401k or for those people in other professions that have the equivalent of a 403b or an IRA or something along those lines, is also similar to what Jeremy said, but not exactly. It's borrowing from that from those policies. So you can borrow from those policies at a particular interest rate, say it's 4 or 5%, and you set the term along with the company around how long you will have to pay back that loan that you will take out. Let's say it's 50K, and you will borrow at 4 or 5% interest rate. But if you invest at an 8% or 6 or 8% interest rate that Demetrius was showing in terms of the cash on, just straight up cash on cash return, not the overall annual return, that is another tool, and that people can use to get into deals, realize some of the cash flow, as well as some of the other benefits that Demetrius highlighted throughout the presentation. So there are definitely different ways to be able to leverage those retirement assets that are kind of just sitting there, or people looking for better yield than what they're getting right now in the market that is getting beat up. There are definitely alternative ways to look into that. But that I just wanted to add to what the gentlemen were saying.
Yeah, and some of those lending scenarios do not come with tax penalties, because you're moving from like one security oriented activity to another. So you can borrow and it won't be a penalty there either.
Right. Other questions from the guest today? Feel free to come off mute.
Do I need to raise my hand?
No, Jim, go ahead.
Hey, Jim.
Hey, how are you? Fantastic presentation. Loving the discussion. It's kind of an interesting market that we're in right now, and a lot of the deals that we're underwriting, owners haven't changed their mindset as what the economy's looking like. So some of the predictions, when we start looking at like 5-year returns, we may not get a positive cash flow year one and even small year two. How do you talk to investors like that to show the loss that you're going to get year one, year two? But if you look at it from a 5-year return, you put $100,000 in now, we're predicting in year 5, the market that we're in is going to be very hot, and we'll probably give you a $200,000 return on that for a total investment. Getting through that year 1.5 cash flow has been a little bit of challenging with investors, and a lot of it is just because I think the transition into the mindset, they were used to the hot market and seeing positive cash flow. Want to get your thoughts and insights on that? Yeah,
no, I think you hit it right on the button. It's what the investors have been exposed to, and what they've seen over the past couple, 2 or 3 years, where it was a feeding frenzy. People were buying properties and selling these commercial properties within a year, and 2.5 to 3x the money within a year to 2 year time span. That's not the norm. The typical norm when you're looking at a deal is within a 3 to 5 year hold, you're gonna usually, let's just give it a range. Your equity multiple is going to be about 2x. People are given the pref equity of 6 to 8%, and then your internal rate, your IRR, after those, let's just call it 5 years, is going to be anywhere between that 16 to 20%. 20% is really good, but these past couple of years, 20% has been it's like, oh, that's not that great. It's because people have been seeing 30 plus, 40 plus, which is it's not sustainable, and that's what's happening right now in the market. So the conversation, to your point, Jim, is when you're having these conversations, it's letting them know, like, hey, look, this is what has happened in the past couple of years is not something that's going to continue to happen. It's not sustainable. If you look at what's happened for majority of the time, these are the numbers that you're going to typically be seeing. And so, to answer your question, when it comes to negative cash flow, typically when you're looking at let's just use multifamily for example. When you're looking at apartment complexes and it's a value add deal, you're probably going to have negative cash flow the first year, sometimes year two, but it's going to be a longer hold. It's a 5-year hold, but you'll start seeing that cash trend come back out in year 3, year 4, year 5, and then when you sell, then you're hitting all the metrics that you had originally. The plan is you hit your metrics that you originally set with your investors. If not, you still have that option to hold it longer. Right? So instead of 5 years, now you're maybe holding it for 7, and then maybe by year 7 you'll be able to hit the metrics that you had initially discussed with your investors.
Thank you. I appreciate that insight.
What other questions from the guest? Well, I've one to throw out there, and this question is about, just maybe food for thought for those of us who have come from the space of, investing in stocks, bonds, and mutual funds. And these are not necessarily directed to you, Demetrius, but this again to the broader group. And things that I want to make sure that people take into consideration when they are comparing or considering investing in real estate versus stocks or having that diversified portfolio. Think about, if you invest your money in the stock and bond market, how much control do you have? Yes, the beauty of being able to pick up your mobile phone or go to your laptop, and within a couple of keystrokes you can purchase some stocks, or to react on your emotion of the latest and greatest of whatever you heard on Bloomberg or CNBC or MSNBC or Fox, and you're thinking that you're going to be the next Buffett. Think about those things. The other thing that I think is important is, do you have a complete understanding of the business that you're investing in? And I would say this, like in when you think about investing in real estate, for example, when you invest in multifamily real estate in particular, and you're thinking about and you're getting the understanding and the overview from operators, syndicators around what the business plan is for the particular property that you're investing in. You first, to go back to other meetings that we've had, you're investing with people that are experienced and that like, and trust. But then when you think about that on the converse to to on in the stock world, when folks think about investing in certain companies, do you really understand what it is that you're investing in? Do you know what yes, may know what Apple and Amazon and Google do, but what about some of those other companies out there that we're just willingly providing our money over to because we think we have the next great tip on a deal that's going to explode. And sometimes it works out that way, and and others that I'm sure many have experienced that, sometimes it does not. And then the other thing I want folks to think about as it relates to this is, think about the people. Are you confident in the management of the company that you are investing in, and that are they out for themselves? Or are they out for the shareholders? These are important things to consider. And there's been history on all sides around this. And if you look back to some firms where there have been some bad actors, leading firms, and maybe not making the decisions in the best in the best interest of the shareholders, but more so in the interest of themselves. And I'm sure many of you can cite some of those examples from Tyco to many others. So the idea here is just make when you are considering these things, make sure that you're asking these questions and you're coming at this with a thoughtful approach, both on the real estate side as well as the stock and bond and mutual fund side. Any other questions or comments from the guest?
I just had a real quick question here. Thank you for the presentation. Really good stuff. My question was, I didn't know, Dimitrius, if you could just go over real quick the UBIT tax. I'm not familiar with that in terms of the SDIRA, what that entails. So.
Yeah. So I myself am not 100% familiar with UBIT tax as well, but essentially what it is it's a I'm trying to figure out what's the best way to explain it. It applies to, so the UBIT tax is applied to earned income of anything over $1,000. And so that, when it comes to the real estate world, when you're investing in a real estate, let's say for example, a multifamily deal, and it is a self-directed IRA, you are exposed to UBIT tax. And I want to let me give you let me see if I can find an example so it's easier to understand. Just give me a second. Let's see here. Sorry. Okay. Let's see if there's an example. Sorry, I didn't not put on my CPA hat on. Sorry. So.
Well, and that's totally okay. We can do a little digging too. I didn't mean to bring up something that is not familiar, but I just hadn't heard of that, and we're kind of newbies to this, so just
Hey, Jen,
there.
I'll throw out there
Hi.
too, and thank you for joining. And one of the things that I learned about the UBIT tax, or unrelated business income tax, is what the acronym stands for. From what I've learned from my CPA and from others, and there's actually someone who's really an expert in this space, and he has a firm. His name is Damian Lupo. He has a firm, the EQRP company, who focuses on this. And what I'll do is I'll make sure I will provide some information when I send out this recording to everyone. I'll provide a link to look into this a little bit more. But the bottom line is that from what I gathered from my CPA, as I mentioned before, is when folks invest in real estate through their SD IRAs, or other self-directed type of accounts, there isn't a potential for this UBIT tax to occur when on the sale of the property, as Dimitrius was mentioning. And that sale, that tax could be substantial, some upwards of 20% or more. And that so there are other ways or other vehicles that investors can use if they are going to use their retirement accounts. They can look for other retirement accounts to transfer their retirement monies into, to be able to invest in things like real estate and avoid that UBIT tax. But I will definitely, along with Demetrius, include some additional information out there for folks so that you can understand that. And as you're advising and speaking to your investors or your network, you can, and making your own investment decisions, you can also have that information handy.
Yeah, that would be great. Thank you. And thanks again, Demetrius, for a wonderful, valuable presentation. Really appreciate it.
Of course, thank you guys.
Hey, Chris, were you saying Damien, that's a focus area of his, is that UBIT tax?
Damian Lupo, he specializes in this area of how to leverage your retirement accounts through his vehicle, which is the EQRP, or it's an acronym, but it stands for ex I believe it's executive retirement plan, or something to that effect. And the idea is it's essentially a solo 401k. It's a part of the tax code, but this solo 401k does not have does not get impacted with a UBIT tax when folks use this tool to invest in real estate.
Okay, thanks, Chris.
You're welcome.
I believe too, Damian Lupo wrote a book on it, the QRP book, using QRPs for real estate investing. So haven't read that one yet, but I'm sure that's stuff in there.
I haven't had a chance to read it either, but I know that definitely covers UBIT in that book.
Jeremy, go ahead.
I think also when you start thinking about, the tax game as a consequence of getting a capital gain, someone should look at themselves and think about, well, what do they really want, right? So when you start talking about, investing in real estate or whatever kind of retirement or investment vehicle you're going to get into, right? But since we're talking about real estate, and I think it's important for people to be able to analyze for themselves. Well, do I just want to find cash dividends, or cash flow, right? Income, for my lifestyle at a certain point outside of me doing work, right? And so if you start to think about that, some of these fancy acronym tax penalty worries can actually go away, because if you've saved up 401k money or whatever these products are, and you want to try your hand at real estate investing just from a silent investment standpoint, where you're going to take some of that portion of that money and move it from one place to another vehicle. Well, one, it doesn't cost you anything, right? Because you can move it without any kind of penalties. And if you leave the money there, we're not talking about short term, so you're gonna look to start getting dividends down the line a little bit. That if you kind of just set it and forget it, the good old Jack LaLanne, is it Jack LaLanne? Whoever makes those chicken things and they turn the rotisserie, he says, set it and forget it, right? If you set it and forget it, and at some point that maturity gets there, you're gonna be collecting. And if that vehicle exits, all you gotta do is, they got that, move it again, right, into another vehicle to carry another return, because you're really looking for ways that in the future you can get income, right? So when you start thinking of, safe cash flow opportunities, that's what you're looking for, and you can really start not worry about tax penalties and things of that nature. Just like if you were putting your money in the stock market, so to speak, right? You're not going to be looking to cash out on it per se. You're looking to be able to make some profit off of it in some kind of way. And at some point down the line, which I think another good point that Mr. Augustin can add here is, hey, if you sell your stock to get the cash as a profitable action, right? You still got to pay a penalty for selling the security. Whereas if you put the money in, if you move it from stocks and put it in real estate, you can keep collecting cash on it, in perpetuity, as long as you keep moving it from vehicle to vehicle, or if you have a good sustaining cash flow on a particular investment, you're in a good situation. You know what I mean? So, and if the rents dip, then you just gotta sit tight. Like if it's almost like insurance, right? If it dips, sit tight until it grows back up, and when the market's up again, you're making money again. So, it's actually a different view, if you look at it from the lens of let's find ways to forget about taxes and penalties, let's find a way to start creating cash flow in my future revenue stream or income stream.
Mm-hmm. Oh, great stuff. All right. Well, I want to, Demetrius, I'll leave you with the last thought, if you'd like, and then we'll go ahead and wrap it up for this evening.
Yeah, no, I appreciate everyone taking the time. Hope the information was helpful. And if you guys obviously have any questions, you could reach out to me. I don't know if I mean, I guess I could go just type it in the chat. I can just type it in the chat, my email address and my number. So if you guys want to talk some more, I'd be more than happy to. And you know, we can go from there. But
Yeah.
I'll put my number in there as well as my cell. So
Yes, and in addition to that, Demetrius, we'll also include this. We'll send out an email to the recording. We'll include your contact information in that as well.
Okay, great.
Well, if
Thanks,
there
Demetrius.
is nothing else, thank you guys for your time this evening or this afternoon, depending on where you are. We appreciate it. I hope everyone has a great rest of their day, and we'll see you again in a couple of weeks on August 4th, where we'll have another guest speaker talking about another fun real estate investing topic. So thank you and take care, and we'll talk soon.
See you guys. Thank you.
Bye.
Thank you.
Thanks.